And the initial estimates from the wildfires are putting the damage as high as, like, I don't think anybody really knows, but some numbers were thrown out like $150 billion. Doug Flynn, who's our money man on this show all the time from Flynn Zito, joins us right now. Doug, and I should point out, by the way, in the stock market today, which will close in a few minutes, a bunch of the insurance stocks were down a lot. Well, I saw like Allstate and Progressive and Travelers and the like. So what do you make of all this?
Yeah. Well, I think, those numbers, the high numbers that you see, like 100 billion, are really the total economic losses. That counts like wages and jobs. But if you're talking about just pure insured losses, I mean, it's still going to be 30 or 40 billion or more. Nobody knows, as you said. But this is what happens if you do have insurance, and some people don't, as we see in other natural disasters. What you're going to do is you're probably going to open it up and read it for the first time, because most people just give me the cheapest insurance, they get it, and they realize things like, especially if they're on the state plan. The state plan has a lot of limitations, and it's sort of the insurer of last resort. And some of those limitations are that it's basic coverage, and it caps out at $3 million. Now, for most people, $3 million sounds like a lot, but a lot of these properties are worth, the average properties are $3.5 and $4.5 million. So people are going to cap out. And then when you really look into it, and everybody should do this, you should open your policy, find out if what you have is cash value replacement and not like replacement value. It's cash value versus replacement value. And cash value just simply is this: if you did some work on your house 10 years ago, and the current value of that is 20% of what it was when you did it, and to replace it now because it costs so much more, you're only going to get what it's worth, not what the full replacement is. So some of these people are going to get far less in the rebuild, and this is how things are going to play out, and you're going to hear these stories as we go through this over the next couple of years.
And then what about afterwards? By the way, that screen that you see in the Pacific Palisades, this bunch of volunteers are helping, dropping off clothes, whatever they can. See that people want to help, and now people are looking through and seeing what they can find. So this is in the Pacific Palisades, which is, as we've been talking about throughout the week, just a beautiful neighborhood out in California. What about afterwards? So, like the idea, like I said, this was a tough issue to begin with in California, insurance. So what about someone who wants to, buy a house out in the state after all of this and get it insured?
Yeah, you're gonna have problems. Not only they're gonna have to obviously come up with some solution that works between private insurance and maybe the state backing it up to some degree. But you're gonna have pressure on the values because a lot of these. A couple of years ago, the state came out and said, here are the highest risk areas for wildfires. Pacific Palisades was like number 5, and so the insurance companies are like, the insurance companies, whether it's a mutual-owned insurance company, which means the policyholders own it, or a stock-owned company, which means the shareholders own it, the bean counters, as we like to call them at the insurance company, are saying, hey, these high-risk returns, we're already barely making money overall, we're losing here, we're making here. I'm going to avoid these high-risk areas. And so they've started getting out of these areas as you'd want them to do from a fiduciary responsibility if you're an owner of the company.
If you're a shareholder in the company, right. So this has been like, is like a sensitive topic already in this country because of the health insurance conversation that we were having before. Now it's like, this is the homeowners insurance conversation. I mean, what would you say to people? I mean, at the end of the day, the way we have it, except for the backup plan, essentially, is we rely on private for-profit companies to provide insurance. So they're going to try to make a profit. So
to a degree, and not an unreasonable profit, as you know. But here's a classic example of perhaps some of those profits they've been banking are going to get wiped out. These insurance companies are going to have a short-term hit to their earnings as they pay out billions of dollars of the money they set aside, and so that's the payback for all the extra money that they made. But really, what we don't want is we don't want something that doesn't work. If you drive these companies out of it and you remove all the competition, if you will, you're going to end up with just government programs, and those tend to be much worse, as evidenced by even the state program here, which, by the way, is back-funded indirectly by the private insurance companies if they run out of money.
Right.
And they do have some money, but they may not have enough. So in a way, you still need the private sector. It doesn't matter whether you're building a bridge or a road. They go to the private sector to get that money. You still need that.
Because we had an update from out there. Thanks, as always, Doug Flynn.